Hi, this is Kathlyn. In this video, I'll be sharing with you how to choose the right financial markets and trading styles that suits you. The objective of this session is to share with you and to help you to understand why everyone must invest. And the second important aspect is to help you to understand the bigger picture of the financial markets and the choices available for you investing and trading. I've been trading in the financial markets for 28 years as of today. And it can be a very complex subject for a lot of beginners. So I'm here to help you to have a systematic framework to approach the financial market so that you can reduce your learning curve. And most important questions I like to share with you is how do you choose what suits you? And last but not least is to help you to understand the framework to approach this financial market to reduce your overall learning curve and maximize your success. Yeah. Because time is the essence, right? So you do not want to waste a lot of money learning the hard way or paying tuition fee to the financial market. Okay, so let's start with the why, right? Why everyone must invest, and this is one of the very important big picture of the financial market. From my 28 years of trading experience, what I discover is the biggest move for the market is influenced by money supply. So what is money supply, right? This slide here shows the amount of money that has been introduced by all the central bank, right? In the layman terms is printing money. So if you look at the US, starting from the top one over here, the blue color is the European Central Bank, right? So the European Central Bank has printed almost $8 trillion, and a lot of the money printing comes right after the COVID, right? To help the COVID triggered related crisis for the overall economy. And the US Federal Reserve has printed about $7 trillion. Right. Then we have many others, central bank, including Bank of Japan, right? The Swiss Bank, as well as the Bank of England. So all in all, it's more than $23.5 trillion. So the question is, where does all this money go? Right? A lot of this money actually got fed into the financial market. Yeah, of course, there are quite a number of them that is quite a part of that is to help the overall economy to recover. Okay, so if you are not participating in the stock market, you will miss out from a lot of this money that goes into the stock market, which actually increase the stock market value. And that's the reason why, even though the stock market is perceived to be overvalued, right, it can still continue to go up until the point in time where this money supply is shrinking. But as of now, these money are still in the market. If you do not invest in the financial market, you will experience an inflation that you cannot overcome by just keeping your money in the bank. And that's why it's very crucial for you to look at investing and trading in the financial market. The question is, how do you choose the right financial market? And this is the big picture that I want to share with you, right? It starts with the asset type. So there are many choice of asset type you can start with. The first one is stocks. You have stocks, currencies, commodities, and bonds. So after you choose the asset type, you still have another question of which market should I trade? So these are the main markets and also the local markets that I've been exposed with, right? So you have the biggest market in the world, which is US. Then you have UK, China, Hong Kong, Europe, which is also a very big market, Japan, Australia, India, Singapore, and Malaysia, right? The reason I covered this Asian market because that's where most of our attendees are coming from. And on top of that, after you choose the financial market, you still need to choose the right trading style. Many people may not be aware there are many ways to trade the financial market. One is you can go for long-term investing, right? Buy and hold for long-term. There's also mid-term trading, which you can keep for a few months. And there's short-term trading, which is about 1 to 3 weeks. And very short-term to the extent of not keeping overnight, right? Just trade for a few hours a night. So I will share with you how to choose this trading style as well. After you choose the right trading style, there's still many financial instruments for you to choose from, which is you can buy direct stocks, right? Or commodities or currencies. But you can also go through intermediate instruments like indices or ETF, which I will explain in a separate video. So what are the other more advanced instruments? We have CFD, options, and futures. So this particular financial instrument is another big subject by itself, which I will cover in a separate video. And once you choose the financial instrument, there are also many trading strategies, right? What are trading strategies? Is a specific criteria on when you will buy, and where you cut loss, and where you take profit, right? How to enter and exit. That's called a trading strategies. There are so many ways to trade the financial market. So even for long-term investing, there's value investing and there's growth investing. Then for mid-term and short-term, there's swing trading and trend trading. And for like those that you don't keep overnight, you can use many ways to trade it, right? So there's a typical intraday trading. There's also scalping, where you just go for a very small spike and then you get out. And within options, there are many ways to trade options. So you can see it can be overwhelming for beginners to choose, what is the right way to approach. So I will guide you through a systematic approach, right, and walk through this one by one. Let's start with the asset type. So which asset type should you choose and how do you choose them? So let's talk about the various asset types available for you. The first one is where I think a lot of beginners should start with, which is the stock market. Yeah. So stocks are basically representations of a stake in the company, right? So, and because it is something that more people can understand, right? It's about businesses and it's a day-to-day products that we use that can help us to understand what businesses is about. So this is where I advise beginners to start with. The next one is currency, right? Where more popularly known as forex trading, and now people are going for cryptocurrency. Yeah. So for currency, it has its own behavior, it's its own influence. Each of these financial assets has its own supply and demand that can trigger the different upside and also volatility. So you need to understand well all these factors that affect the respective asset type so that you can manage the risk better. And the third one is about commodities. And there are many different commodities you can trade. And the more popular one is gold, oil, right, corn, soybean, and there are also commodities for all the different plantations, right? Even like a lean hog and so on. Yeah. Then the last one is bonds. Bonds are usually traded by big companies, like hedge funds and the banks and so on. And individual traders seldom trade bonds directly, but individuals can trade bond using a bond fund, like a unit trust fund that trade bond. So these are the four. So how do you choose? These are the decision consideration. The most important part is you need to understand what are you looking for when you trade the financial market. Right? So we are not here to have this gamble mentality where win big and then lose big as well. The most important one is for you to be able to achieve consistency, right, and manageable risk. And of course, everyone wants to get the best performance. After trading all these different instruments, I found that the stock market gives the best balance between reward and risk. Okay, and it's also the least volatile. It also depends on your experience level in the asset type. So if you're a beginner, I would suggest that you start with stocks. Then you can move to understand the currency later because let's say depending on which market you trade, right? There will definitely be some exchange rate influence to the market, but it is not crucial for you to trade so many instruments. Even if you invest or trade in stock market in itself, it's sufficient enough to make you financially free, right? Within currencies, there's also the typical forex market and cryptocurrency market, which require more experience, and it's also much more volatile. In the commodity market, it's a totally different animal altogether, where you have to understand what actually influence each of those commodities that you trade. So that's the second criteria. The third one is your capital size. The lowest capital is typically currency, but there are other considerations besides low capital, right? Stock market also has a low capital, right? So if you have like $2,000 US, you can still trade the US stock market. And commodities typically require a minimum of 5,000, ideally 10,000 US and above. Last but not least, right? You need to understand your objectives and your risk tolerance. Right? So don't go into any of these asset type without understanding what is the risk aspects that you need to manage. So let me move on to share with you the performance difference for this asset type. So let's start from the 10 years ago, right? Because you cannot judge an instrument performance just from 1 year, right? You need to look at long range on at least 10 years performance so you can see how it performed over the different market cycle. So if you can see here, I chose a few stocks as an example, right? So that you know what are the example of performance that you can get if you directly invest in stocks. Because there are many ways to invest in the stock market. You can also go through a fund, which is like an exchange traded fund, or you can go through indices. If you want to select stocks directly, then it makes sense for you to go through a proper screening criteria. And it justifies that because when you know how to screen stock, you can get much better performance. Like in this case, Amazon performed 1,451% over the 10 years period, which is 145% per year. And I choose another example here, which is Microsoft, also a high performer, over 100% return per year on average, right? Then you can also go for a index fund, right? So this is a NASDAQ 100, which is representing the top 100 stocks, right? Selected from the NASDAQ stock exchange. Primarily, these are high growth stocks. A lot of them are from technology sector, but it's not only tech stocks. Okay? So this is still very good performance, 55.5%. And then I contrast with gold because many people, thinks that gold is good, but you can see here that gold only performed 2% in that whole 10 years, right? So such a big contrast, right at the bottom here. 2% for 10 years, that means it's only 0.2% per year. And the crude oil futures, in fact, is negative. Coffee futures, right, 13% negative, and euro dollar versus US, the forex market is minus 18%. I did not choose crypto here because it will distort the figure, and cryptocurrency is something that I don't advise beginners to go into. It's more for sophisticated investor, and you need to be prepared to lose everything, right? That's the kind of mentality you need to go into because it doesn't have a tangible supporting asset for it. It's very speculative. I don't mean that you cannot invest in crypto. You need to understand the instrument well. So based on this, right, you can see that the stock market and understanding how to choose specific stock will give you the best performance, yeah, and consistency. So let me give you another context related to the Forex market. And the Forex market is also very big, and you can trade many different pairs, right? When you approach Forex trading, you always trade one currency against the other. I've been trading Forex for many years before I decided to focus primarily on the stock market. So look at this Euro versus US chart, which spanned over 28 years. So it goes up and down, and in the end, it stays, as of now, is minus 7.45%. So the message I want to share with you here is Forex is not designed to trend up in the long run, right? So the government, the central bank, are there to regulate the exchange rate to make sure that it's stabilized. So since the central bank wanted to stabilize the currency, you don't expect a big trend, right? Just imagine if your home currency is having a big change compared to the US dollar, it will disrupt a lot of the import and export for the country, right? It will create a lot of imbalance and havoc, right, to the economy. And that's why this is what the central bank doesn't want to do. And for selected reasons, sometimes for particular economic environment, they want to push down the currency, right, just to enable more export. And sometimes they want to let it go up, right? So it strengthens the currency and there's more capital inflows. Yeah, but it will go in a certain range. So the biggest influence to the Forex market is actually the central bank policy, right? Of course, there are many other factors like your home country GDP growth, political stability, and so on, right? And whether it's a reserve currency or non-reserve currency, how much money is being printed. So that itself is another animal altogether. Why I think the stock market is still better than Forex market, mainly because if you know how to select great companies, right, then there's a solid backing for that. If the company continue to make money, right, if you select strong companies, like Microsoft and Amazon, right, those are very strong fundamentals company. This company, as long as they continue to add value and they make money every year, the value of the company will trend up. Okay, and the more they can have a consistent return of profit every year, and also have the growth for the future, then the value of the company will go up. So it will be able to trend in the long run. That's why if you want a long-term growth, right, investing in stock market, strong fundamental companies are still the best, and it's the safest compared to the Forex trading. As well as commodity. Commodities go by supply and demand. When there's more demand, let's say more demand for coffee, there will be more people who want to plant coffee, right? Then it will create more supply. Then the price will come back down. Same for oil, right? Oil used to be having a significant demand until there are more provider for oil that came in. And that's why the oil price can come down back again. But stock market is not like that, right? Stock market has a long-term track record of going up. And only when it's way overvalued, there's a correction. All right. So based on this, I still think that the stock market is the most worth your time, yeah, to focus on. The next one is after you have decided on asset type, right? Then the next one is which country market do you want to trade in? As you can see here, there's so many choices. So my preference is the US stock market, and let me share with you why on the next slide. But let me give you a bit of the context on why I don't choose the rest of the market. During my early stage when I become a full-time trader, right? After I quit my full-time job in the Intel and AMD, I was trading the global indices. So I'm pretty familiar with a lot of this market. I've traded the US market, UK and Hong Kong more on the indices, Europe indices and Japan indices. And Australia, I've traded some of the stocks there. I didn't trade India stock market before or Singapore, but I traded the Malaysia stock market. So based on all this stock market, a lot of people thought that the China and Hong Kong market would be great to invest because people see that China is the future. However, China market is actually very volatile and there's not enough transparency there. And Hong Kong market is also very volatile and there's a lot of government intervention. Later on, when I show you the stock market performance, right, it will speak by itself. Okay. Australia and Europe market doesn't have enough exposure to the various sector, whereas US is the largest market in the world and it is the most diversified in terms of sector. And it actually has a leading position in a lot of the future mega trends. Yeah. Okay. So let me move on to give you a context as to why I prefer to focus on the US stock market, right? And this is what I would recommend to everyone as well. So when you want to select a certain market to invest, first we need to look at which country has the most successful global companies. And I guess most people, would have known that, the country with the most successful global companies is actually US. And it's not just for one sector, it's across many sectors, right? A lot of tech companies, major tech companies like Microsoft, Apple, Facebook, Amazon, they come from US. Of course, China have Alibaba and Baidu, but it's very limited to certain sector, right? If you talk about the top, the healthcare company, you also have in the US, top financial companies are also from the US, okay? And the second factor is, in the US market, because it's a very mature market, you can actually make money in many market directions. There are so many variety of trading instruments like CFD, options, and futures. Even if you trade stocks, you can trade up or down, right? You can make money on the way up, or also make money on the way down. And this gives you the flexibility to be able to make money in any economic condition, right? Whether the economy is booming or when there's a recession. So this actually gives me the assurance that I can trade for a living. Yeah, it's a very, very important factor to me. On top of that, it gives you many choices of leverage instrument which allow you to trade with lower capital. And the third point here is also very important, right? It has the most online research material. After I become a full-time trader, I've traded the Australian market and the UK market, and also the global indices. A lot of these countries don't have enough research material that are free, right? It's more difficult to find information for you to do a lot of this research compared to the US market, which has a lot of very in-depth research and also a lot of free information. And number 4, right, is US is the biggest stock market in the world. Right? When we want to trade a high volume stock market so that it's easy to get in and easy to get out, what we call high liquidity. Why is this important? When the market is very popular, it can offer a lot more range of financial instruments. And with more participation, the bid and ask price between the buy price and the sell price will be much closer. Right? And you don't want to invest or trade in a market that has very few people or lesser volume. Yeah? Because when you want to sell, you may not have enough buyers to buy from you. Right? That will be a higher risk for you to manage. So let me share with you some statistics here. A contrast between Bursa Malaysia, which is from my home country, and a US stocks, right, which is Apple. Right, the Bursa Malaysia itself, the total market cap, which is when you add up all the capital of the companies listed in the Malaysia stock market. Malaysia has 1,000 plus companies listed in Bursa Malaysia. It's 434 billion in terms of US dollar. But just one stock from the US market, right, Apple itself is already 2.3 trillion in the total market cap. And in the United States, there are 6,000 plus companies being listed there, right? So that already shows how big is the US market. And last but not least, US stock market has the biggest influence to the world market. In fact, the Euro market is about 80% correlated to the US stock market. Okay, because I have traded many of the global indices before, and I can experience the correlation between this market, with the exception when there are local central bank policies or the local central government policies like stimulus that would diverge it a bit, yeah, during those periods. Okay, so based on this, do you see that US is still one of the best financial market to focus on? And let me show you some statistics. Right, I'm a numbers person, so I'd like you to prove to you the performance over the past 10 years. So you can see here there are 6 different benchmarks. The first one is the US Nasdaq 100. So what's US Nasdaq 100? I explained earlier, is the 100 stocks, right? Usually the top performer stocks or high growth stocks, right? Supposed to be selected to represent the Nasdaq stock exchange performance. So these stocks are performing 56% per year, right? Really amazing. The next one is US S&P 500. These 500 stocks are selected to represent the US stock market performance, right? US stock market has 6,000 plus stocks. So, and you can see here, these 500 stocks are selected to represent the various sectors. Okay? There are 11 different sectors in the US economy. Even with this 500 bigger sample size, the performance is 25.8. Isn't it amazing? Just contrast this compared to putting it in a bank, which give you about 2 to 2.5%. That's more for the Malaysia fixed deposit rate, right? So other countries could be higher or lower. You can see this is at least 10 times the returns you can get compared to putting in a bank. And that's the reason why, right, putting in the stock market is still better. However, you need to understand it and approach it in a proper manner, right? Get yourself properly educated before you invest. And, I like to contrast those other markets that people are interested, like Shanghai, right? Shanghai Composite Index is only 4.3% return, right? So you can see the red line over here, right? It's almost flat. And it's been going down significantly for the past 1 year because of the China policy, right, is not conducive for the stock market, and many foreign funds are pulling away, right, from the China stock market, and also China stock listed in the Hong Kong stock exchange. So you can see the Singapore stock exchange is only 10% for the last 10 years. It's only 1% average return. And the Malaysia KLCI use 30 stocks to represent the Malaysia stock market is only 0.5%, one of the lowest performer in the region. And compared to gold is minus 0.2%, right? So when people think that gold is a safe haven, this chart shows you it is not, right? So based on this contrast here, do you see that US is still one of the best performing market? But the question is why? And is this sustainable, right? The most important reasons why US stock market can perform is because of the significant money supply, also the economic stability. The overall performance of the stock market is also supported by strong fundamentals, right? A lot of even with the COVID-19, many of the tech stock and healthcare stocks and are making great money, right? And this is actually supporting the whole growth, right? So there's the overall money supply as well as the fundamentals of the company as well, which is better than compared to many countries like in the Europe region, New Zealand or even Japan, right? More of their revenue are from the tourism industry, so they are more severely impacted by the pandemic. Whereas for US, because it has a diverse income for the GDP, so they can overcome this crisis in a faster manner. And also the vaccination rate is also high. So based on this, it justifies why US is still one of the best market to invest or trade. So after you choose the respective country financial market, you still need to decide how do you want to trade it or invest in it. So there are 4 major ways to do so. Like the first one is long-term investing, which is buy and hold for longer term, which is typically around a 3 years duration. It doesn't mean you must hold for 3 years. So when there's a trend change, you can still get out, okay? But typically you must have that big longer term horizon. So this page here focuses on how much time commitment is needed for each of this style. So the first one, long-term investing will require about 1 hour a month because it's designed for people who are, more busy and you want to be less active in the stock market. The second trading style is midterm trading, which has a holding period for a few months. Basically, you ride the trend until the trend change, right? You enter and exit based on the trend reversal, like entry and exit when the trend change. You will hold it for typically a few months and it takes about 1 hour a week. So if you have more time, then you can get more active to choose more stocks. And for swing trading, which is short term, you hold for about 1 to 2 weeks. You trade a range bound area or different patterns. When they break out, then there's another range for you to trade. Right? So it's a very short term spike, and it requires about 30 minutes to 1 hour a day. And the most active trading style is called intraday trading, where you need about 1 to 2.5 hours per day, roughly about half an hour to 1 hour before the stock market open, and then you can stay on for about 1 to 2 hours after that, and you don't keep any overnight positions, right? And this method is the one that compound your money faster. These trading styles are just duration. In fact, there are many ways to trade the many duration. Example, right? For long-term investing, there's growth investing and value investing. So for growth investing, the focus is on investing in growth stocks, right? Those stocks that are still having high growth for the future. And value investing is a methodology that's more conservative, where you want to buy only when the valuation drop a lot. And typically this happens when there's a big market correction. So it requires more patience, and you may also miss out a lot of opportunities when the valuation is high. Okay? It's a preference based on how passive or active you want to be. So what are the differences in terms of the returns for these trading style? So let me give you an example of a 10,000 starting capital. It doesn't mean that you must have 10,000, right? Just a round number, 10,000, easy for mental calculation. And a contrast, putting in the fixed deposit, or some countries call it term deposit, compared to investing in stocks like swing, trend, and intraday trading. So the first line here is the growth rate. Like how much you can compound the money. For fixed deposit, depending on the country, it can be ranging from 1.5 to 2% per annum. Investing in stocks, conservatively, you can get about 20 to 25%, depending whether you're going for like value investing style or growth investing. Even for growth investing, in some years you can get even above 30%. But I'm being conservative here in the forecast. When we look at the percentage return, you need to take an average over many years, like 10 years period, rather than specific year. Where some years could be better performance, some years could be weaker. For swing trading, it's about 2 to 5% per month. Right? So you'll be doing a few trades per month, and this is the average. And I will analyze it on the second line here, right, to make sure it's to turn it into per year. So it's a per year comparison across the board. So I'm taking the lower end of the range, which is 2% times 12 months. That will give you 24% per year. And for trend trading, it's 30 to 60% per year. So I'm also taking the lower range here. Right. And for intraday trading, it's 5 to 10% per month. Right. So I'm taking the lower range times 12. So you get 60% per year. Just bear in mind, this returns, right, it's only after you gain the experience or discipline in it, right? So if you are new, there will be some initial learning curve for that. Okay, and you need to make sure that you follow the process step and also the rules, right, for the trading. So let's look at how much it can compound over the long run. If you put in the fixed deposit, right, after 10 years, you only have 11,000. Okay, it doesn't help you much. So if you go for investing, compounding about 20% per year, right, you have 61,000, right, over the 10 years period. And if you go for swing and trend, it will be between 24 to 30%. Okay, so that will give you still a pretty good return here. The highest return comes from intraday trading, because you can recycle your money every day when you trade. If you make money, it will compound. But of course, we look at an average return over at least 100 trades to see what is your percentage return per month. Okay, so based on this, you can compound the money faster. But do not choose the trading style just based on the return. You need to suit your time commitment and personality as well. Okay. So let's move on to the next page, which is how do you choose the right trading style? The first important criteria is your time commitment. So if you have more time, like 2 to 3 hours a day, then you can go for a very active trading style like intraday trading. If you have not much time and only about 1 to 2 hours a month, then you should go for investing instead. Okay. So as what I mentioned in the earlier slides, the second criteria is your capital, right? So if you have higher capital, then you can go for investing or more, mid to long term investing and trading. But if your capital is small and yet you want to compound faster, then you should go for shorter term trading, so you can compound your money faster. The next one is your objectives and expected return, and everyone is different. If you have a high expected return, then a shorter term trading style may suit you more. And last but not least is your personality, right? Which will dictate what type of instruments that you can handle. So if you can take complexity, then some of the more sophisticated instruments like options and futures may suit you. The other part on trading style is your decision-making speed, right? If you can make fast decision-making, then intraday may suit you because you need to make real-time decision-making when the stock chart is still moving. But if you need more time to decide, then you may want to go for those trading style that doesn't require instant response like swing, trend, or investment. After you choose the financial instrument to trade, example, you can use either direct stock, CFD, or options to trade the stock market. Right? Then you still need to choose how do you want to trade it. Those are called trading strategies. Right? Example, whether you want to use a swing, trend, or intraday way to enter and exit. And this itself is a financial instrument is a big topic, which will be covered separately in the video. Okay, do look out for that video. So having seen the big picture over here, right, the most important is how do you make choices that give you the highest probability of success, right? So this is one of the top-down approach that I use. First is you choose the asset class, and if you are new, then stock is the best asset class for you to go for. Then the next one is which market, right? So as I mentioned earlier, US stock market is one of the best consistent performance financial market I can choose. And third is how do you want to trade it, like the specific trading styles and instrument. So if you are relatively new and your capital is bigger, then you can go for investing style. If you wanted to go for higher returns and don't mind, investing more time into it, then you can go for shorter term trading, right? So you can start with stock market. If you need leverage, then you can look at using margin instruments like CFD. And once you get familiar with this, you can use more sophisticated instruments like options, right? So just with this itself, you can already be able to make good money from the financial market once you master it. You don't really have to trade everything out there, right? It's about mastery that gives you the performance, not trading everything out there. Okay, that's very, very key because I used to trade many, many different instruments, and I realized that, when you trade too many, you get distracted. All right. So this is the big picture, right? So you can see how big the financial market is. We are here to guide you the right way to achieve the best consistent performance. So if you're interested to find out more, right, this is just a high level big picture. Each one of these can be a big topic by itself. Right? And so let's move on to the next slide here. How do you approach, like once you choose, let's say, the stock market and a specific trading style, how do you approach it? There are actually 4 basic principles that I use, right? The first one is, just here an example of a stock market, is how to select the right stock, right? So you start with selecting the best stocks in a market, but you don't buy it yet. The next step is to time it, right? After you select the best stock, when do you get in and when do you get out? So that's called timing. Next is how much do you buy? That's for protection. You don't put all your egg in one basket. And how do you manage the risk, right? So we have something called a stop loss. If it goes below a certain level, like I only risk less than 1% of my capital at any one time. And I don't have more than 5% concurrent market risk overnight, right? So this is one example of the protection. So once you have this, you're already protected and have good repeatable methodology, then you can go for multiply, using some leverage instrument to make it more affordable and to make it faster. So we have another seminar that cover this in detail, which is about 2.5 hour seminar if you are interested to understand more about this. And just to give you some idea about where we are coming from, we are actually a very established educator in the financial market. As you can see over here, we have a very structured methodology to teach our students. Overall, we have 5,000 plus graduates already over across Malaysia, Singapore. We have students in Vietnam, Hong Kong, Australia, and New Zealand as well. Our company started way back in 2008. And over the years, we have been awarded many different awards, like top financial training company in Malaysia in 2013, and also the most preferred financial educator in the InvestFair for 3 consecutive years that we participate in that forum. Okay, and this is our key differentiator here. We, as a company, we have the most experienced coaches, right? No company out there has 29 coaches. Okay, most of them has just a few coaches, and this actually helps us to have a good coach to student ratio to support our student effectively. And we have the most effective support in the market, where we have a lot of hands-on tutorials, guidance, and automation to help us to analyze whether our students have followed our methodology correctly, right? Automated templates and so on, with a lot of statistics of their performance. And the last but not least, we have the most comprehensive and systematic curriculum you can find in the market. As you can see here on the diagram, all the way from the foundation of the stock market to the different trading style, right? We have long-term investing, swing, trend, and intraday approach in a systematic progression to build a strong foundation. We also have instruments like CFD and options, and we go to even for total beginners all the way to very advanced students. We still have something for you. For example, whether you want to understand the overall industry as well as the macroeconomics perspective that influence the stock market. We are also one of the company in Asia, the only one in Asia that has a master trader bootcamp focusing on trading psychology. How do you become a master trader, right? You have to control your greed, and there's a lot of psychology aspects that you need to master to create a consistency. Okay, so if you are interested to learn more, do join our next free seminar. It's 2.5 hours, and this is where you can register, or you can scan this QR code to register and find out more about our courses. Okay, so I look forward to see you in our next seminar.